Okay, welcome to Stock Talk with Nico Kritikos. Today we're going to be going through 5 stocks that I'm buying in the month of February 2024. All of these stocks I've owned for at least several months. These stocks are just still trading at good prices, and that's why I'm still bullish on them. So let's get started with number one. We're going to be looking at Starbucks here. I think everyone's familiar with this one of the most well-known companies. Um, the thing is, when I go to Starbucks all around, I've been to a lot of Starbucks around the country in the last couple of weeks. Every single one is always has a line, right? There's always a line here, and that's why it makes me even more bullish. If we go to this company's net income, we can see that let's move this. It's been, what was it? Last year it was 4.1 billion, and so I mean, I don't see this company's numbers slowing down anytime soon. If we want to look at Starbucks PE ratio, we could get an idea of what the valuation is looking like. So we'll come down here and we'll see. Let's zoom up on this. Okay, so here, let's get closer. Okay, so right now it's trading at about 26 times trailing earnings. And, of course, it can get a little bit cheaper, right? Maybe it goes down another 10% or something like that. But over the long run, I think this stock is still a good deal at this price. And that's why I'm going to be, holding this until it gets to about $130 a share. Now, the next one on my list is going to be Nike stock. This one was a pretty similar story where it's a very well-known brand and, they dominate the market that they're in. Nike, I have about 23 shares at $101 a share. And this is another one where I would say roughly about $130 to $140 a share is kind of my price point for what I'm aiming for. If we look up the P ratio for this one, we could get an idea of where the valuation lies as well. And what we're going to see, if it will load, then what we're going to see here is a P ratio of about 30 times trailing earnings. Very similar to Starbucks, right? This is in a very similar situation to Starbucks. So let's zoom up here, and you can see that it kind of has been hovering around this 30 times earnings for a while. That's kind of like the base point, right? I guess what you look at then is you look at, are the earnings going up, right? So this is another one that pays a 1.4% dividend. And there you go. EPS is going from 3.2 to 3.5 to 4.2 next year. So with that, we could see that, this is if it trades at 30 times earnings and they do a little over $4 of EPS, then it's going to be, $125, $130 a share or so, right? And that means that's assuming that it stays at a 30 times earnings. It could very well go to 33 or 35 or something like that. And then they could also beat our earnings. So if we come down here, we can see that the last 2 quarters, they actually beat by quite a bit. 21 and 27% are significant beats. So that's a good sign. Next stock on my list is going to be Tesla. This is one I've talked about a lot. I've owned it for several years. It's just recently, and this isn't there's been multiple times when this stock has a huge drop and the sentiment turns bad. And, I make a video saying this is why I'm buying it, and then it shoots up. Just like a little over a year ago when the stock went to $100 a share, I made videos about it then. And then look, it went all the way up to almost $300 a share last year. Well, now we're back down, not quite as cheap as it was, but $180, in my opinion, is still a great price to be buying. Even though my cost basis is $23, I still think that this price it's at right now is pretty much assuming worst case scenario for Tesla. There's a lot I could talk about Tesla, but I don't want to make this whole video about that. So pretty much I know the market is kind of struggling right now, but the thing is, I don't think it's strictly EV based. And I know that EVs have problems like the batteries and how much they cost and how to dispose of them. Um, some of them catch on fire. There's all these different things, right? Or people don't, maybe the range isn't far enough. There's not enough charging stations. There's all these other things, right? But in my opinion, those are most of them are temporary problems, right? That can be fixed. The other thing is last year, the Model Y, Tesla's Model Y, was the #1 selling vehicle in the entire world. I believe 1.2 million vehicles sold. So That says something as well. Then, you got the Cybertruck, you have the semi truck coming. We still have the robotaxi thing coming. We have Tesla robots coming. We have their energy storage business has been growing super fast the last couple of years. And then we have the services, we have the insurance, we have so many things. So I wouldn't doubt that Tesla is over $1 trillion company at some point. That's why I think that the potential is still so big for this company and the downside is so small because even if we were conservative with let's go to the PE ratio. Even if we were conservative with the valuation and the ratio you want to pay for it, this isn't going to be this isn't Tesla's peak right now. This is, as far as earnings and sales go, this is not 2023 is not going to be the peak for this company, right? I think most people would agree about that. So this whole thing with EVs slowing down, I think it just goes back to the fact that the economy is in a rough spot and interest rates are high. So it's not just EVs, it's pretty much the entire car market, as well as other things like homes and lots of other industries. But if we go to the Tesla PE ratio here, and let's zoom up to the most recent, we're going to see that right now it's trading at 59 times earnings, okay? Now let's look up Tesla expected EPS. And again, it's just, I only see them, let's see what analysts have them doing. I only see them going up from here. So they have some problems, but I think they're temporary problems. That's pretty much my case for this. I also am a big supporter of Elon Musk. I think he's a great person to have running that company. So we got what? So EPS is going to be down a little bit, right? $3 of EPS. But then next year, we're looking at $4 of EPS. So Tesla has, for a while now, been trading at a P ratio of, let's say, it looks like anywhere from 34 times. When it was trading at 34 times, that was when the market and the economy was in, we had a pretty severe crash at that point. I don't think that's too realistic. So I would say, and then 81 times is possible, but even that could be a little bit rich. So I would say, somewhere probably closer to like 60 or 70. I think that's more realistic. Even though it spends time trading at 70, 80 times earnings, right now we're down to 60. So somewhere around this 50 to 60 mark is probably where Tesla's going to trade, okay? So if we look at it like that, then we're looking at next year, 50 times 4 is 200, okay? 50 times 4 is 200. So that means that's like base case. That's like at its minimum. That's what I see it going to. So I think the risk to reward right here is still very attractive. So that's Tesla. The next one on my list is one that I did not think I was going to be buying up until about 2 weeks ago. I decided to do this, and I didn't make this a huge position because it is a ADR. It is a foreign company, but it is one of the most probably on the safer side of things as far as Chinese and foreign stocks go. So I have starting to make my position here. I got 30 shares at $74. And as of this week, I think the stock just jumped up today, almost 5%. So hopefully it's starting to move and it keeps moving up. But this is another one where the risk to reward is very attractive because it trades at a price to earnings of 10. Okay. And this stock used to be $300 a share, right? And it used to stay, between $150 to $300. Well, now it's been trading at $100 and below for several years now. So I think with this being one of the most important, biggest companies in China, I don't think this is going to last. There's also news that came out talking about how China is trying to kind of reestablish some momentum and put some money back into these Chinese companies, and that should push the stocks up, right? That should help with the sentiment as well as actually putting money into the stock to push the valuation up. And so as the sentiment and trust and the momentum builds for this company, the PE ratio should build along with Alibaba's earnings. So if we take a look at Alibaba's earnings, let's see how that's been looking. And right now I started reading a book, Jack Ma's. It's like a Jack Ma biography. It's not an autobiography, but it's a biography, and it just talks about all the different stuff that Alibaba offers, all the different services. They have, the cloud business, they have an e-commerce business, and it's crazy how much they do in sales and how important of a company they are in China. So revenue, we're looking at roughly in the last 5 years, they're growing at about 28% per year. Okay. $868 billion. Net income, the last 5 years was only about a 2% increase because of this giant drop we saw from 2021 to 2022. Then we saw from 2022 to 2023 a nice jump from 60 to 70 billion dollars, and so hopefully that trajectory continues. Okay, if we look at, I think return on capital is one of the most important things to look at, and it's only 7%, not the best. But again, this is a company where they're operating on a very large scale, so it's probably okay. They have smaller profit margins, but yeah, Alibaba, the risk to reward is pretty attractive here. So that's why I'm taking a chance with this one. Normally I would not do Chinese stocks, but this one is, I don't know. It just, I'm taking a chance with this one because I see the risk to reward as still attractive. Then finally, we have one that I've owned for a while, and that is going to be UPS. This is one that's definitely been struggling lately, large part due to the economy and the interest rates. But they are the largest in this space, and they're in a space where the package delivery thing, this isn't an easy business to get into. You have UPS, Post Office, FedEx, and maybe Amazon. And that's it. It's not, this isn't an easy business you can just break into and start taking market share. So as you can see, this one I built into a little bit bigger of a position, 24 shares at $175 a share. And right now I'm down 17%, right? So not great. One good thing about this stock recently is that one of the insiders started buying shares. So that's a good sign. But again, I think, let's see, let's check what the analysts' estimates are for this company's EPS. And that you also got about a 4.5% dividend, so that's good too. But this one, I think it's just a matter of time. The thing is, they laid off a decent percent of their workforce, of their employees. That should help cut costs. And then again, the whole interest rate and the inflation and the economy things, those are all temporary. Maybe that lasts throughout part of this year, but that's not going to last forever. Okay, so that's why that's another thing that makes me bullish about this company. So we're looking at, again, EPS is going to drop a little bit this year, and then next year it should, go back to an all-time high, $9.75. Revenue growing, anywhere from 2 to 5%, and yeah, that's why I think UPS is also the risk to reward is pretty attractive here. So those are my top 5 stock picks for the month. Comment down below what you think.